Peter Lynch summarized it best. He said insiders might sell their shares for any number of reasons, but they buy them for only one: they think the price will rise. And to be fair, the data does seem to back this up. Stocks with insider buys have historically outperformed the market over different periods of time. And despite the market trading right at all-time highs, there are still a multitude of stocks seeing insider purchases. So in this video, we're going to be looking at 3 of those stocks that have recently seen insider purchases, 2 of which I actually own in my personal portfolio. To analyze these stocks, we'll be using forecaster.biz. This is a tool I've started using over the last few months, and one of the cool features is the way you can overlay the fundamentals with the share price. For example, when we're looking at Caterpillar, we can see how they've grown dividends and how the share price has also been growing along with the fundamental growth. I have a link to them in the description. Be sure to check them out. So the first stock that has recently seen insider buying is Caterpillar. Caterpillar is probably one of the most underrated stocks in the market right now. If we scroll down, look at the 5-year return. It's up 234%. In the last 3 years, up 142%. And look at just 2025, up nearly 60%. Now, here's what's so interesting about this. Look at the stock in the last 5 years. With the sales overlaid, we can see sales were growing at a pretty high rate up until 2023, but the last couple of years and for the trailing 12 months, it stagnated a little bit. So why has the share price just absolutely skyrocketed in the last year? Well, the answer is simple. Caterpillar is currently in the midst of a massive business transformation, and a lot of people don't seem to realize this yet. Caterpillar's largest and fastest growing segment in 2024 was energy and transportation. Now, why would that be the case? Why is this the fastest growing segment? Well, ironically enough, it kind of plays in line with the AI race. The surge in AI has caused a massive demand for energy, particularly in the US. Look at the US electricity demand from 2010 to 2023. We're talking about a 4% growth rate. But from 2023 through 2035, we're talking about a 25% growth rate. The surge in AI is causing a massive demand for energy. The growing network of data centers needs enormous backup capacity, and Caterpillar, through its natural gas and diesel power systems and industrial turbines, is positioned at the essential link of the chain. And this is something the market has started to wake up to. Just look at the average earnings per share estimates for Caterpillar over the next few years. We can see in 2026, we're talking about 20% growth. The following year, another year of 20% growth. Earnings are projected to surge in the coming years. And like I mentioned earlier, this is actually a stock that I own in my personal portfolio, and obviously it's done extraordinarily well. We can see right here, I'm up about 227% on my Caterpillar position. But it isn't just the share price that has surged over the last few years. They've grown their dividends at a high rate as well. In fact, if we go ahead and scroll down, just look at the dividend growth here on Forecaster over the last few years. It looks like right here in mid-2019, they're paying out about $1.03, and the most recent dividend payment was $1.51. So we're talking about nearly 50% total dividend growth in a span of about 5 years. And with the way that earnings and free cash flow are projected to grow here in the future over the next few years, we could continue to see that same type of trend. And as of right now, if we go over to the fundamental tab, we can see that starting dividend yield is just a little bit over 1%, but the shareholder yield is actually sitting at 5.5%. Now remember, shareholder yield also includes share buybacks, and if we look at the rate they're buying back shares, it's been quite rapid. 591 million shares outstanding as of the end of 2018, and they've reduced it all the way down to about 486 million. Now, what's ironic about buying back shares is it actually makes it easier for the company to grow its dividend on a per share basis. Buying back shares makes revenue per share higher, it makes free cash flow per share higher, and then of course, it can make dividends per share even higher. So again, Caterpillar, not getting a lot of attention right now, but it should at least be on your radar. It should at least be on your watch list for further analysis. Next up, we have Waste Management stock, and this is a company that's in a very unique situation. Look at the history of insider transactions. We can see there was a long history of insiders selling the stock over the last year, but we just recently, in the last few weeks, saw an insider buy, and it was a significant amount. Now, why would they have bought this stock? Well, look at what's been going on with the share price over the last year. It was remaining within this choppy range, but recently after their Q3 earnings report, we saw a significant sell-off, and right around right here is when we saw the insider purchase at the company's lowest price in over a year. That's worth making note. Now, if we zoom out even further and look at the last 3 years, we can see really this was the cheapest price since around February of 2024. So that's a little over a year and a half ago. Now, keep in mind, yes, the share price is pretty much the same as it was 18 months ago, but what's happened during that time period? Sales have continued to grow, dividends have continued to grow, and that will likely continue to be the case moving forward. And with this recent sell-off, we can see the PE multiple has now gone below its historic averages. This is a company that typically trades at a premium, and there's a few different reasons as to why that is, which we'll discuss here in a moment. But we can see for a lot of the past few years, the company's been trading with PE multiples of around 33, 34. And right now, if we look at the fundamental tab on Forecaster, it's sitting at 31.94. That's higher than a lot of tech stocks. So let's talk about that for a moment. Why would that be the case? Well, we have to understand why people are willing to pay premiums for stock. It typically boils down to two different reasons. The first one is companies growing earnings at a high rate deserve higher PE multiples. For a lot of people, that one's more common sense. But what a lot of people fail to do is to understand why stocks who have very predictable, stable, and resilient cash flows trade at a premium. And Waste Management is a perfect example of that. If we go back and look at one of their investors' presentations from a few years ago, I love to point this out anytime I talk about this stock. But they pointed out 75% of the company's revenue has annuity-like characteristics. 75%. This essentially means that they have recurring revenue. Now, when you think about recurring revenue, maybe typically you think about software companies, subscription companies like Netflix. But the reality is a lot of those types of companies, yes, they're subscriptions with recurring revenue, but they have high churn. Customers come and customers go. That's not the case for Waste Management. When they gain new customers, they typically stick around, and that becomes very predictable recurring revenue. Now, if we jump forward and look at the investor's presentation from this year, here's what's actually pretty impressive about the growth. If we look at collection and disposal organic revenue, their 2019 through 2021 financial targets were between 4 to 6%, but because of COVID, it was in that 3% range. But over the last few years, it's been bumped up to the high end of that, about 6%. So we're talking about the top line growth here. But look at how fast free cash flow is growing. Now remember, free cash flow is the ultimate driver of share price appreciation over the long term, more specifically free cash flow per share. So we can see free cash flow has grown at 13%. That is very good double-digit growth, especially for a more mature company like Waste Management. So not only is free cash flow growing at a double-digit rate, but we can see they're buying back shares as well, which again means free cash flow per share is growing at an even faster rate. So when you get free cash flow per share growth of above 13%, combined with the fact that around 75% of the company's revenue is recurring in nature, you start to see why this type of business a lot of investors are willing to pay a premium for. But there's one more thing we have to take into consideration. Scroll down and look at this next slide. Yes, we can see Waste Management does have a history of outperforming its indexes. But there's more than we're looking at right here than outperformance. We have to remember, investing isn't just about returns, it's about the risk you're taking on relative to those returns. I could right now go and invest in some tech-heavy fund, and I'd have years where I way outperform the market, there's no doubt. But I'd also have years where I dramatically underperform, because those stocks can be so volatile. And what we can see is not only did Waste Management provide superior returns, but they had much less volatility when you look at the beta. The beta versus the S&P 500 is just 0.6. And really, if we look at Waste Management track record, we can see this is true. Go back over to the Overview tab on Forecaster and look at the performance, especially since 2012. Since 2012, they have only had 1 year where they ended in the red, and that was 22. Now, keep in mind, in 2022, the S&P 500, for reference, was down by about 20%. But Waste Management only fell by about 3.6%. So really, when we look at the past 10 to 15 years, it's a pretty incredible track record of returns for Waste Management, but it's also an impressive track record of not having drastic drawbacks. Now, to be fair, I get it. I can see why a lot of people would be uncomfortable paying a PE multiple of close to 32 for this type of business. But it's clear there's a lot of investors out there who favor predictability. They favor that recurring revenue, and they favor this type of business model. And now we know that one of those people is an insider with the business. This was the first insider purchase we've seen in quite some time. And while I definitely consider myself a much more fundamental investor versus technicals, it is pretty interesting to see the trends over the past 5, 10, 15, or even 30 years compared to the current year. You can see this year has not been the norm for waste management. And then finally, we have Omega Healthcare Investors. Now, this company is different than the previous two we've looked at because it's a real estate investment trust, and like a lot of REITs, it's more on the high yield side. In fact, if we look at them right now, the starting dividend yield is sitting at about 6.14%. Now, again, here's what's interesting about the insider purchases for this stock. Look at this. There's a long history of insider sales, and in fact, before the insider purchases we saw in the last few weeks, the last insider purchase was in November of 2021. Now, the two most recent insider purchases came from the CEO and the Chief Investment Officer, where they bought about 20,000 and 11,500 shares. Now, why would this be the case? If we look at the share price, they're pretty much trading at the highest price they've been at in the last 5 years. Well, we'll get to that in just a moment, but let's make sure we actually understand the business model behind this REIT. Omega Healthcare Investors, again, it's a REIT that essentially provides financing and capital to the long-term healthcare industry, so think of real estate like skilled nursing facilities or assisted living. As of right now, they have about 1,024 facilities in 42 states, plus Washington, D.C., as well as 2 locations over in Europe. Now, if we take a closer look at what this concentration actually looks like, we can see they're pretty heavily in Texas. But occupancy there is relatively low. That's not typically something we want to see, but all these other locations look to be doing fairly well. Now, with that being said, I always say a REIT is only as good as the tenants that it holds within its portfolio. So one of the things we have to actually ask ourselves is, do the tenants in OHI's portfolio have the ability to continue paying rent? Well, let's dive into that question. We'll start right here. What are we looking at? We're looking at operators with EBITDA coverage of below 1 time. Now, what does this mean? Well, this stands for earnings before interest, taxes, depreciation, amortization, and rent. So a ratio of 1.0x means the operator is earning just enough to pay rent, but if it's below 1, then it means the cash flow isn't enough to fully cover their rent payments. So obviously we want to see their tenants at above 1. But here we can see a few examples of tenants who are kind of in a dangerous space. They're all below 1. Obviously this isn't what we want to see, but let's keep this in mind. They only make up about 4.3% of the company's total rent. In fact, if we scroll up, we can see a better picture of what the ability of OHI's tenants to pay rent actually looks like. We can see about 26% of their tenants are doing incredibly well with their EBITDA coverage ratio of above 1.8 times. Then we have 1.2 to 1.8x. That's about 47% of their portfolio. So between the two, we're talking about close to 75%. Then we have between 1 to 1.2x, sitting at about 15.7%. So the vast majority of their portfolio is doing fairly well, and they can feel pretty confident they're going to continue to pay rent. But with that being said, we still have to ask ourselves the question, why has this stock been surging over the last couple of years? Well, in reality, it's about the projected adjusted funds from operation growth in the future. Now, we have to remember, when we're talking about REITs, we don't necessarily focus on earnings per share or free cash flow per share as the bottom line metric. We focus on adjusted funds from operation. This is the key metric for REITs, and it also essentially tells us how sustainable the dividends are. And we can see when we look at their recent earnings report that was released on October 30th, they actually increased their full-year adjusted FFO guidance. And for reference, if we look at analyst expectations, they're projected to grow adjusted FFO at a very healthy rate moving forward, which hasn't necessarily been the case for this REIT in the past. So for reference, in 2025, if adjusted FFO comes in at $2.94, and then we look at the dividend payment and we see that the dividend comes in at $2.64, we know adjusted funds from operation can cover their dividend. And there's a little bit of margin there as well. And so if adjusted funds from operations continues to grow, then what's interesting is that dividend will be able to continue to grow at a sustainable rate as well. Now, for reference, this company doesn't necessarily have a history of dividend growth. In fact, we can see the dividends remain the exact same for the last 5 years, but that's because adjusted funds from operation has been a little bit choppy, but again, that's projected to change. So how should we value a REIT like this? Well, the easiest way is to simply use a dividend discount model. We're basically valuing the stock based on how much it's paying out in dividends and how much that dividend will grow in the future. So right now, if we assume 0% dividend growth, we can see the stock would be worth $31.53. And again, for reference, if we look at Forecaster, for a large portion of the past 5 years, that's around the price it was trading at. Again, this means there was no dividend growth priced in. But now that the stock has surged, it essentially means the market expects dividend growth in the future, and that makes sense since they're also projected to grow adjusted funds from operation. So how much dividend growth is actually priced into the stock now? Remember, they're trading at about $43.70. If we bump this up to 1%, we get to $36. If we bump it up to $2, we start getting a lot closer, and if we bump it up to about 2.25, we get extremely close to the current share price. So the market is telling us they believe this stock will be growing dividends at a rate of about 2.25% moving forward. The question we have to ask ourselves is whether we think that's justified or not, because if it'll be slower, then the stock is overvalued, but if it'll be faster, then the stock is undervalued. In reality, even though this stock is really trading at its highest price in 5 years, if they get close to these growth rate projections that we're seeing from analysts, I do think it's possible we could see slightly faster dividend growth. So even if they get to 2.5%, we're starting to see a little bit of upside. If they get to 2.75%, we're talking about 10% upside, but keep in mind, you're also getting that nice high starting dividend yield, which is coming in at about 6.14% according to Forecaster. So this is certainly an under the radar REIT. It doesn't get a lot of coverage, but it is fun to see the company doing well. So go ahead and let me know what you think of these 3 stocks we looked at today and what you think about the insider buying. Again, be sure to check out forecaster.biz at the link down below. And like always, don't forget to like and subscribe to the channel.